Welcome back, everybody. This is Squawk in your headlines. Donald Trump removes green card holders from his immigration order, but reports suggest the travel ban still applies to the same Muslim countries. Iraq's Prime Minister tells CNBC they shouldn't be on that list.
We've asked for the US for a review. We wanted Iraq to be removed from that list. And I have received some positive messages from President Trump and others.
The US President holds interviews with 4 prospective candidates for the role of National Security Advisor as he scrambles to fill one of the most important positions in his administration.
A $143 billion flop. Kraft drops its bid for Unilever after the Anglo-Dutch rival says it sees no financial or strategic merit for shareholders. And Uber under fire amid a sexual harassment scandal. The CEO, Travis Kalanick, calls for an urgent investigation to the claims that the company's HR department tried to play down harassment of a former engineer.
A dividend dilemma. We look at payout growth or lack of it across the world with Henderson Global Investors.
So, welcome back, everybody. This is Squawk Box on CNBC Europe. Let's have a quick look at the German PPI figures. And the point to immediately draw to your attention is the numbers come in stronger than the expectation. The expectation was for plus 0.3% month on month, plus 2% year on year. And the figure as delivered, plus 0.7% on the month, plus 2.4% on the year. And if we look just what the data looks like with the exclusion of energy, where we know we've seen price increases, plus 0.6% on the month and plus 1.8% on the year. And you were muttering darkly about challenges for the ECB.
Yeah, I think because you've got the political challenge this year with elections just about everywhere, and let's face it, Greece is looking horrendous again as well in terms of the standoff there as well. You've got the pressure that's being seen on OATs and BTPs and what have you on the underlying, but taking the yields higher because concerns about political concerns and the strength of the balance sheet. Amidst that, you've got German inflation, which is, well, there was a figure above 2%, wasn't it? Of 2.4%, the year-on-year figure. So does that mean that the ECB can stick to its inflation mandate, or does it have to look at the stability side of things and think, look, there's too much other stuff going on for us to withdraw?
Well, ECB members on the weekend were saying they want to see that this is enduring, that's not just a one-off tick high that you've seen in the Eurozone countries, in particular in Germany as well. So it's going to be about the cycle now for 2017, not just a one-off number.
Very briefly, Dan Lacalle is with us.
Good morning.
Good morning to you and welcome. Quick comment around this German data, because it does somewhat fit in with the profile of an improvement in pricing in corporates and better earnings.
Sure. Yeah, absolutely. I think that what we're seeing is first, inflationary pressures are stronger than what we expected, and more importantly, as you very well said, the inflation ex energy, which is what matters for industry, etc. So that's a good element in terms of the earnings profile, because earnings so far have been a little bit better than expected in Europe. This is the first year in 6 years in which we see better earnings environment. So I think that we have to monitor this, but it's absolutely right. The Germans are going to be worried about this because the ECB at the same time has to start thinking about tapering in the middle of this year, and at the same time it has about 1.1 trillion euros of excess liquidity. So there's a big debate happening, and I think that in any way we want to look at it, these inflationary pressures are very evident all over the European Union.
You're a very smart man. I read your book. In fact, I proofread it for you.
Thank you.
Tell me something. Why do we look at core? Here's a basic question for all of us, taken back to 101. Why do we look at core and look at inflation with energy and food costs in there as well?
There's never been anyone going out of a supermarket or a service station that has said, damn, food prices are down this month, or gasoline prices are down. It gives no benefit to the economy to see energy prices or food prices going up too much. What you care about is inflation that is excluding those elements, because that's what, for example, drives means that prices
you can't get any foodstuffs out of the ground without transportation costs. You can't do anything in this world without feeding people as well. So I actually think these are relevant figures, having the energy and the food in there.
Global comparison, you need to take into account subsidies, and there are a lot
it's
of
just like
subsidies
EBITDA, taking earnings before you take all the other stuff out.
Prices, so you can't compare.
No, but if you want to think of inflationary pressures as something positive for growth, as something positive for earnings, as something positive for wages, that's why you look at core inflation. If you look at headline inflation, you have all that matters that is negative for imports. That's why you use that figure.
I mean, more prosaic, you could just say it's fixed fees variable. Because if you see core rise, it means it's going to be stubborn and persistent and with us for some time.
Exactly.
If it's variable, it could be that, you know, we had a bad crop of potatoes this season.
OPEC
and
cuts.
Temporarily, potato prices have gone.
Yeah, OPEC cuts. Nothing to do with the strengthening economy.
Talking of land.
Talking of land, yeah. Do you know, I very often admit I'm wrong. I mean, I'm very often wrong, but very often do I just blasé it out. But as Karen nailed me, actually, January the 9th over Bovis as well. I remember it very well, Karen. Basically, Bovis Homes was having a shocker when a lot of their rivals were doing very well still as well. And you called me out on this one, Karen. So let's see how they're getting on post the era of Mr. Ritchie as well. They're talking about a difficult year for the group following a period of ambitious growth. Full year revenue actually rose 11% to £1.055 billion. Profit before tax was down 3% to £154.7 million. What are they saying for this year? That's what I want to know.
That's terrible.
Financial position strengthened, Karen. Net cash to 38.6, focused on 2017, making it a year when they reset business and deliver on their operational priorities.
Let's face it, they need a reset. 183 million was where analysts were expecting. 154 was where they've come through today. I think just in recent weeks, analysts have brought their expectations down to even flat, but we've got the pre-tax number down 3%. So it's even underwhelmed the underwhelming numbers that the analysts had expected today.
And the very interesting thing about this number is that the industry is compressing like a coiled spring for a spate of home building in this country like we haven't seen for a very long time, because the amount of land that is now being set aside for new home building is astonishing, and the councils are under incredible pressure to greenlight the development. So I think we're going to see a lot of homes built. The interesting question is whether that is going to be good for margin and profitability or not, given how tight it seems we're getting on home price inflation.
You say good for the economy too. Who's the end buyer? It's meant to be those who have not had access to the property market rather than those investors overseas that buy in cash. So the end user, what they come in with 10% deposit, then you've got interest rates going up. What's their overall equity when you have a marching higher interest rate environment that we are possibly going to see? And you might have a view on this, Dan, about what the central bank's going to have to do here with inflation and whether they're just going to be able to sit idle and look through some higher prices over the next couple of years.
Unfortunately, for a short period of time, and while there's uncertainty about Brexit, it is very unlikely that the central bank is going to take action. But it is true that at the same time, what you're seeing is that all those pressures, weakening currency and rising interest rates, are going to affect how home buyers are going to be able to jump into the property ladder. So you have to be worried. You're already seeing some concerns about prices, and you're already seeing some concerns about about demand weakening. But I don't think that the Bank of England is going to make any or give any message, and definitely not take any action until we have a clear picture on Brexit.
Yeah, and whether inflation is something that's happening globally or whether it's just related to the drop in pound. We'll have another go at this.
I personally think that inflation is being underestimated in many of the OECD countries right now.
That's a good point, Dan. We'll pick up on that in just a moment. Meantime,
Daniel Lacalle is with us, CIO of Tresses Gestion. Daniel, I wanted to come back to the point that you made about corporate earnings here, because if investors need to hang their hat on the Trump bounce on anything, it's that it is forecasting an uptick in corporate earnings. Best earnings in 6 years, this earnings season, but does it represent the peak or the beginning of a new cycle?
Mm-hmm. Well, I think it can start a new cycle, fundamentally because so far in the last 6 years, most of the earnings season has been disappointing, and by this time you would start to see big earnings downgrades, and also companies' outlooks were very, very poor. So I think that it can be a significant difference, because at the same time you're seeing also indicators that are proving that it could be that there could be more strength to it. For example, consumer confidence, France, you're seeing also manufacturing indices, etc. They're all going in the right direction. The outlook is very important. It's not just that the earnings season is better, it's also that companies are giving better guidance, more robust guidance about their outlook of at least for the year. So I think that what has been in effect an earnings recession in the last 5 years could be starting to come to a different trend, a much more positive trend. And I think that that's what investors have to cling to, because the markets are expensive, of course. So they have to look at this inflationary pressures, and they have to look at earnings and guidance to defend valuations as they are right now.
Let me challenge it a bit. I mean, absolutely right. There's many good reasons, I guess, to own stocks rather than anything else at the moment. But the level of indebtedness in the United States, where so many of these S&P companies are looking at, level of indebtedness, household debt, is just off the Richter scale now as well. There's been some really big numbers over the last week or so as well. Should we begin to worry that US consumers are getting maxed out, and hence that great source of revenue increases and the end of the earnings recession, as you mentioned, actually could be on very shaky ground?
Yes, on one side, you've seen the numbers on credit cards, for example. Numbers on delinquencies are rising. So you have to be worried about indebtedness, but at the same time, if the tax cuts, as they have been at least expected, happen the way that they have, the increase in disposable income would be much larger than what any of the analysts were expecting, and that definitely makes a big difference in terms of the ability to repay debt. So it's a double-edged sword, but in the tax cuts there's a lot of the answer, and also in the strength of the dollar. Funnily enough, everybody that's concerned about the strength of the dollar doesn't see that consumers mostly have their wealth in deposits, and therefore it's important that a strong dollar remains, so that their ability to continue to consume is not hindered by the rise of inflation.
So what do you do with discretionary? Because some analysts have pointed out that the market now has pushed towards being more overweight discretionaries, but at this point, before we have reporting season across the course of the week in the States, there might be some questions around the E in PE, the profitability and the earnings of some of these retailers. What do you think we're going to see? Is it going to be disappointing at a guess, or do you think there's going to be better numbers finally coming through?
I think that consumer discretionary is a sector in which the trend of improving earnings estimates and outlook is probably going to find not so positive an environment, because analyst estimates and all that was embedded in valuations to justify the current multiples were a little bit excessive. So you have to be very, very nimble, in my opinion.
What's been interesting is, if you look at the performance of the European market since 2009, we've followed the States, but we haven't done as well as the States. But even then, the DAX has put on 4,000 points, I think, over the 6 years you talk about, where we've had no earnings improvement. So my concern is, who pips who at the post here? Because if that PPI number in Germany tells us anything, factory gate prices are going up, the ECB may begin to taper and normalise rates. Surely it's the central banks that have driven this rally, not earnings.
Absolutely.
So at the point where the ECB decides it's time to taper and hike rates, does that take the momentum out of any earnings-driven rally?
If the earnings season and if the strength of the earnings overtakes the risk of tapering, yes, but you have to think on one side that the European Central Bank is caught between a rock and a hard place. On one side, it cannot reduce the pace of purchases, because the governments would not be able to sustain an increase in yields because of the deficits and the debt that they have. On the other side, it cannot raise rates aggressively, because Europe, and particularly banks, still have a tremendous amount of problems in terms of debt, and both in non-performing loans.
Daniel, we're going to leave it there for the moment. We'll catch up with you after this break as we look at the start of the European equity session this week. It's President's Day, but that hasn't stopped the markets from looking pretty sprightly at the start of trading, with the DAX storming ahead, caught up the best part of 1%.
So what's the outlook for a sector that has such poor margins in a housing crisis? Because that's the issue. The issue is that costs run out of control when the market's booming, and margins compress radically when the market is not booming. So it looks like a catch-22 situation. What is the outlook for a sector that has such a tremendously difficult way of passing on cost into the consumer?
Well, I think what the good news for the sector in general is that the government is very much focused on providing the land that they can do their job. And this is really mostly targeted at helping the smaller and medium-sized house builders to join the game again, having been kicked out of it during the financial crisis. But it will, in effect, also help the larger home builders. The status quo has been pretty nice for them. There's a continuous need. That's why you read such positivity in the statements of the other builders, apart from Bovis. That's going to continue until we see some solid details on how things are going to change from the government, which we haven't seen yet. There's no reason to think that the reasonably pleasant background is going to change.
Thank God they've got a good philosophy there. Thanks, Jem. That's great. Really good stuff. Gemma Acton updated us on the Bovis news and the UK housing market.
Kraft Heinz has walked away from its $143 billion bid for Unilever. The company's announced the, quote, amicable decision in a joint press release yesterday after Unilever rejected the US food giant's approach on Friday, saying it saw no merit, either financial or strategic, in Kraft's offer. A Kraft Heinz spokesperson said it had hoped to negotiate on a friendly basis, but decided to drop the bid when Unilever made it clear it did not wish to pursue a transaction. I thought the press did a fantastic job getting ahead of this story very, very quickly. And what came up was the fact that you had a CEO at Unilever, Pullman, who has really had a different take from the C-suite about giving more back to workers, also about the enduring legacy of Unilever. He took investors on a roadshow back to where it all started at Unilever, and he really wanted an independent standalone company. The press really seized upon this and said, well, who's coming in? You've got 3G Capital, which is behind Kraft Heinz, and this is a man that's gone in there. He's created a massive giant AB InBev previously, but he's also had a history of budgeting, zero budgets and cost cutting, taking jobs out of the equation. This is not going to pass muster when you take a look at UK regulation and Dutch regulation. So I think investors were then sitting back saying, well, how is this ever going to pass regulators, and what is the future of this deal? Then you saw it retracted over the weekend.
Dan, what do you do if you are a Unilever shareholder at this point? Maybe you've just bought your shares recently in anticipation of some M&A action. Do you sit here and wait for somebody else to rock up, or do you accept the fact that maybe shares are going to drift lower because the bid premium's taken out?
I think that the story is far from over. So I think that what you will see is some weakness, obviously, because clearly when a company gets in defense mode and wants to remain independent, you have to acknowledge that factor in the multiples. But I think
that's done, Dan. You're wrong.
You think so? You think it's over?
Toast.
Completely over?
Why do you think it's far from over? I think it's completely and utterly toast.
I don't see how the company remains independent in the next 5 years.
I do. Because there's only one company in the world that could buy it, that make the synergies. There's only one company in the world that could have bought it, and that company's now said, you know what? This doesn't work. We've got a very aggressive UK government. We've got a very tricky political scene in Europe, which means if we're going to cut jobs that were kind of jobs that were cut at Cadbury's and cut at other acquisition targets that were taken over and gone back on their word of previous, this one is not going to fly politically. You've got a new industrial policy, the new philosophy, as Jem was talking about, coming from the Tories as well now. There's a new economic nationalism happening globally. There was one company in the world that could have done this. I think it was the company that did it there, and I don't see how they can come back to this one again.
If you're right, Steve, run away like no tomorrow, because obviously what you're going to have is not only the bid premium falling, but multiple compression on standalone basis. Yeah. Because at the same time, what you have is, the too many aggressive estimates following the share price. And
I tell you what, I think it does do though, Dan. I think it puts smaller targets in place. Still, people think, this one's 143 billion. We can't do that one, but maybe the 50 billion or the 60 billion. The one thing I will say is the shares have been pummeled this morning in the pre-market. Apparently, now I don't know if this is where they're going to open, but they're called down by IG to 33.65, which is 11.4% lower, or 432 pence coming off the shares.
So the market sees what you're saying.
So all those inspirational option traders that Jeff was mentioning from All those
they just
you're
changed
right.
focus,
Inspirational option traders, those geniuses
Telepathy.
who had the telepathy on Wednesday and Thursday to buy the call options on this one on a ratio of about 500 to 1 compared with the puts that were trading, the highest volume since May 11 or 2000. Well, I think you're going to have a tough time if you didn't get out on Friday.
Well, I think the company pretty much alluded to this, the fact that the deal was made public so quickly in the process, so early in the process before they could
Well,
really
no,
get
they
all their
alluded
ducks
to the fact it was made so
in
quickly. They
order.
didn't allude to the fact there were people out there who had this inspiration to buy this stock.
I think the other point you raised is a key one, though, but what else is a target here? And we interviewed the CEO of Diageo recently, and he laughed at me saying, oh, we're not prey pretty much at this point, we're going to focus on what we're doing. But I've written a piece that's going to be in City AM tomorrow about scale being the only game in town now.
Yeah.
The way companies are surviving all the political turmoil,
Yeah.
all the noise, whether it's Trump or Brexit, plus inflation,
terrific
pressure on
point.
margins come into the mix. It's about
And
scale
that's
at
why,
this point.
strategically, it may not have worked for Paul Polman, but strategically for the acquisition, for the acquirers, fantastic, because you could strip out so much management and have all those global products. If you got it through the regulators, it would have been stunning for them.
The issue, though, is the amount of leverage that was in this deal. And I wonder if this was perhaps one of those indicators that we are in the last round in the bar and it's time to go soon, because the cheap funding is not going to be around for much longer. I don't know, what's your read?
I don't agree that the cheap funding is not going to be there for longer because of the amount of liquidity, and even though interest rates might be going up a little bit, they're still extremely low. And if the numbers make sense for an acquisition, it's still, you can still understand that kind of leverage in the deal considering the synergies.
Yeah.
So banks and oil companies leading the dividend growth, is that sustainable? That's the problem, because most investors are long-term and they're looking for yield, but at the same time sustainability. If you're paying the dividend by increasing debt, as oil companies are doing with oil prices still way below their break-even price, how do you get to that in terms of total shareholder return? Because, isn't the dividend going to just disappear out of your equity valuation and just get you nowhere?
I think you've got to, there's slightly different environment for the oil companies versus the mining companies. The oil companies, the big integrated oils, very few actually cut dividends in 2016. As you said, some of them were issuing debt to make sure they could pay their dividends. We only saw cuts from ENI and Repsol and ConocoPhillips. All the others managed to sustain dividends. With the oil price where it is now, we're in a much better place than we were at the beginning of 2016 when oil was below $30 a barrel.
Sure.
So we do have a little bit more ballast, if you like, but we're going to keep a very close eye on it, because you're right, it is quite a tight cash flow situation for some of those big oil players. But I do think they've done a really good job in reducing the capital. They've made a lot of, they've sold a lot of assets. They've been much more efficient on their operational side, and so the break-even for oil is lower than it was.
Sure.
So yeah, we're going to keep a close eye on that for this year.
Can our audience do at the moment with regard to just equities? Buy the market, sell the market, do what?
Well, I think that clearly if they take no risk, they're going to earn no return. Whether you're a European or a UK investor, interest rates are going to remain very, very low. Most of the bond markets offer virtually no returns. I think if they're feeling that they have to be invested to earn a return, I think the equity markets of both the UK and Europe look quite attractive, because there's good dividend yields out there. Even the 3% from Unilever is better than it's twice as good as a UK gilt at this moment in time. I think if they're feeling a little more aggressive, they can look towards the growth stories in India and emerging markets, where we think the structural reform is going to lead to better returns for equity investors. But clearly you're running some currency and some political risk, and clearly the more you focus on political risk, the more you worry about Europe this year, which is arguably cheap, but we have an electoral super cycle to face from next month onwards, and we run the risk of Trump and a trade war, any tweet from now on. So we wait to see.
I'm more inclined to be invested in developed markets. I think that Europe and the US make more sense, both from the low risk perspective, as you very well say. But I also think that what investors are going to find out is how excruciatingly painful it is going to be if you hold on to your bonds while inflation creeps up. Because right now it's sort of a shock denial situation. But if inflation continues to creep up, and core inflation, as we said before, in particular, you're going to really start to struggle both in pension funds and and another important thing is that last year we had the perfect storm of allegedly negative news or catalysts that could rock the market. They didn't. So this is not a bad year to take a little bit of risk, in my opinion.
What about all those bond funds that are stuffed full of negative yielding bonds at this point? I mean, to what extent does that represent an accident waiting to happen here?
Well, clearly I think it does. I think we've seen in the last 3 months most bond funds down 3 to 5% in absolute terms. It's the first losses since, I think, 06 and 07. I think as people realise they're not going to protect the purchasing power of people's wealth against inflation, and you might actually lose some money, that clients are going to have to realise they have to move towards assets, whether they're property assets or equity assets, that are going to protect that purchasing power. The issue for certainly European investors is that they have never yet for any calendar year lost money in bonds, and therefore they've got to wait for those valuations to come through quarter after quarter to your scenario, and then they realise they're in the wrong asset class. And we also think in Europe that there's something like 3 trillion euros in cash in private hands.
Gotta leave it there.
Okay.
Rumour is you've done enough to get back to the 2-hour slot. Is that right? Actually, no, it's still to be debated for the producers. Neil, lovely to see you. Neil Dwayne, Global Strategist, Allianz Global Investors. Dan will carry on his 2-hour slot after this break. Plus, it's Fashion Week. We're going to hear from some top designers at this year's event. That's coming out later in the show. Excellent work, Hadley. Thank you very much indeed for that. Dan, it's really difficult, I think, to tie up geopolitics with market moves as well. And we've seen so many people make so many mistakes over the years by saying this has happened in Spain. I remember, talking about your own expertise. I remember, was it 2004, the Madrid train bombings?
Exactly. Yeah.
I came on set here. I remember we had a markets desk over there, and I had to talk for it. And I didn't really believe what I was saying. And that was kind of almost one of the last times I ever said, actually, this event equals this on the market as well, because I vowed not to kind of extrapolate too much.
Yeah.
It's a really difficult conundrum, especially at the moment, isn't it?
It is. It is because what we're seeing right now in the markets is that markets are taking the best of both worlds. They're taking on one side the inflationary pressures, the tax cuts, etc., but ignoring completely any type of risk from trade wars, from security issues, etc. I think that the geopolitical landscape has got a lot more complicated because what we were used to understand in terms of both the allegiances and the alliances between different countries has completely changed. Now what we were just listening before about Europe is very worrying, because if we get disaggregated Europe, if we get problems in the European Union, that's going to make it very tough.
We'll come back to this if we get a chance. Certainly it's going to be a very important topic.
You're strangely quiet on this subject.
Yes, I'm fascinated. I'm fascinated about why is the industry so concerned about Brexit being a global industry, and if the pound falls, costs fall.
Yes.
But the pound falling is good, but of course all the other costs are going up, and also they have a lot of foreign talent within the industry as well. So what happens to them here?
For Central St Martin's, isn't it? If it's cheaper for them to come here, I mean, that is a hub of our fashion network, isn't it?
It is the hub, but will it put people? It might put them off, though, Steve, if they don't have the attractive tariffs to come here. And of course, within the brands, Mulberry, Topshop, they're talking about their foreign workers within England.
It's constant reorganisation, though, isn't it? I mean, don't forget, these are companies that built out huge in Hong Kong and now have had to retract because people are not shopping in Hong Kong. It's a reorganisation, a constant expense that comes out of the profitability of a business.
It's a real balance. It's good on some parts, bad on the others, and it balances out.
So when they talk about getting with the Prime Minister and talking about the challenges of the industry, what is their concern? Their concern is whether there's going to be immigration laws, or whether...
I think it's the immigration laws. That's the strongest concern, and they need more reassurance from the government now. They're not getting any reassurance, so the uncertainty is affecting them badly.
It's a really good point, actually. This reassurance that everyone wants them to... Look, I think, yeah, absolutely. The moral thing to do is to say to all the people who are here already, look, your job's fine, your status is fine. Yeah. But I understand why Mrs May might not want to do that from a bargaining chip point of view. I know it sounds, and I know it's an awful, awful thing for all these wonderful diasporas here in the UK. And to be fair, the same for the British ones on the continent as well. But I know morally that Mrs May should say, look, do you know what? Your jobs are fine, you're safe. But from a tactical point of view, I kind of understand where she's coming from. I don't know if anyone else has a view on this.
I think you need to be the bigger person here.
So do the right moral thing.
Do the right thing. Yeah. And you know what?
Reassure.
Let the rest of the world criticise those who don't.
Yeah.
Tanya, good to see you. Thanks very much for coming in and helping us out with that. You've got 30 seconds to just give us a final piece of wisdom here, Daniel.
Well, my view is that we still have to monitor very, very carefully this reflation trade. My view is that we need to be very, very much on top of earnings season to continue to be holding equities, but it's still a market in which you want to be switching out of bonds and into equities.
Nice to have you on the programme. Thanks very much for joining us.
As always, a pleasure.
That's Squawk Box this Monday morning. Daniel Lacalle joined us from Tressis Gestion, where he is CIO. Tomorrow's guest host, Stuart Richardson, partner RMG Wealth Management. Thank you, everybody, for tuning in. Street Signs coming up next.